Welcome everyone. Welcome to today's episode of the Market Wrap. I have with me Mr. Pankaj Pandey. And what an interesting week this has been. Lots and lots of volatility. So to say, while the markets overall were happy in green, but we have seen some intraday moves in this week. So what is happening in the market right now, and what's the outlook like?
Yeah, hi, good evening, Vishu. I think overall, with the kind of massive victory for NDA, I think policy continuity is ensured at the center and the state. And I think the overall launchpad is also ready for trade deal to sort of happen. It could probably take week or 2 weeks, but it should happen soon. So with all that in perspective, I think market is all set for challenging its previous high of 26,300 and head for a new high. And I think this week what we have seen is that despite the volatility, we have seen markets gaining about 1.5%. Some of the sectors which were not doing so well, the likes of IT, defense, pharma, I think they've made a strong comeback. Some of the segments which are already doing well, say for example, real estate, FMCG, so they have taken a sort of a breather. And but overall sense is that whatever the near-term correction we have seen a strong rebound from those levels. And I think inflation also has been sort of helping. So inflation has sort of come in at lower levels. And I think what has also happened is that when we look at globally, Nasdaq has started to sort of wobble a bit, largely because of the concerns regarding valuations on the AI side, and that is having some positive rub-off on the IT. So if you look at sectorally, BFSI plus IT plus other segments, I think all of them are poised to sort of do well, and which is why it gives us confidence that markets are all slated for a new high. So I think all things are in place for markets to do well from here on.
Absolutely. Also, sir, I think there's some news from the inflation front. Lots of things to be happy about. What is all? Was it all about?
Oh yes, I think in we should. So, for example, in US, the concern now is that whether they are going to see a December rate cut or not, and accordingly, we are seeing markets wobbling there. But in our case, the inflation here is at a 10-year low. So, inflation last reading for October is 0.25%, and this is again the expectation was only half a percentage. So it's a 10-year low kind of inflation what we're seeing, and this clearly means that the it clearly opens up the space for rate cut, at least 25 bips. And if I sort of strip out gold, because gold has been sort of doing very well, the inflation will would have been negative of 0.35%. Inflation-wise, we're not seeing much of a challenge. In fact, if you look at largely this lower inflation is because of the food inflation. So food inflation is down somewhere around 5% and so that is having an effect. But overall sense is that this year again, RBI was expecting inflation of about 2.6 odd percent. So that should sort of come down, and which obviously gives the room for a 25 bps kind of a rate cut. But yes, next year, same time around, because of lower base, the inflation is expected to be higher. It can't remain at lower levels. But yes, I think good news from the inflation perspective, because what it does is that I think overall from data perspective, we can go in for a 25 bips kind of a rate cut. It depends on RBI, but I think overall ecosystem is in place for a rate cut.
Right. Another thing about October, I think the retail investors have somewhat had a subdued participation in the markets. Any particular reasons for that?
I think we should we read a lot of headlines in terms of the inflows getting tapered off and all of it. But I think last 2 3 years or last 1 year or more than a year now, despite the fact that the markets have not given a very great set of numbers in terms of returns, I think it's about 7 odd percent. But even then, the inflows have been intact. Now, when we sort of look at October numbers, the overall inflows have been 25,000 crore. Compared to that, September it was 30,000 odd crores. Now, if you sort of exclude the NFOs, this gap is even more wider. So, the NFOs, excluding NFOs, September number was 30,000 odd crores. So, from that perspective, a 20,000 kind of a number looks alarming. But I think I would want to sort of highlight some of the other aspects because historically, we have seen that whenever the market does well, uh, people usually sort of book profits. And this time, what has also happened is that it has also coincided with the festive season, and we have already seen a great festive season from a lot of segments. And so our sense is that with market rallying 5% in October, along with that, I think with the festive season, people have taken some profits out for spending. So I don't really see this number as sort of changing the course. The SIP numbers are quite steady. In fact, they've gone up to about somewhere about 29,529. So they continue to sort of inch up. And we have seen the inflows in most of or outflows in most of the segments. So, for example, mid caps or small caps, which were getting good amount of inflows, we've seen lower inflows. Again, our sense is that it is more to do with the profit taking. And I think the only segment where probably there are some flows is the flexi cap category. Otherwise, I think most of the categories have seen some bit of a profit taking. So from that perspective, I think the inflows are lower, but it is we are not seeing a reversal of the trend in terms of inflows.
Right. So this uptick that we have seen in the markets, a lot of it has come from IT as well, which posted a pretty, I think, around 3% up. IT, Indian IT was. Why? What was the reason behind this?
So historically, Vishu, we have seen a good amount of correlation between performance of Nasdaq and Indian IT, but that ratio is at a two-year decade low. And largely, Nasdaq has done very well because of the AI-related theme working out well. On top of it, what we have seen is that the US government has been sort of tweaking policy on the H1B B policy front. And that has caused some anxiety in the overall IT pack. Now, what we are clearly seeing is that in the last 2 months, whatever announcement has happened, when the announcement started to sort of happen, there is a complete U-turn in the overall announcements. Because earlier it was announced that $1 lakh will be charged, then it will be recurring, then it was clarified that this is a one-time fee. Then it was further clarified that students who are on F1B visa there and residing there, they need not pay this 1 lakh fee. Then I think what has also happened recently is that the Trump has come back and said that they need specialized talents which are not available in the US. So I think in the nutshell, what it clearly means is that the US is softening its stand probably on H1B front, which is sort of a triggering a relief rally. And the overall sense is that it's producing different kind of benefits in different companies because tier one names, they are more beaten down. In fact, when you look at their exposure is 30-35% to the typical BFSI segment, the banks. So those are sort of the segments where the growth is not so much, whereas the tier two IT companies are doing a lot more better. So I think they've got exposure towards insurance and other BFSI segments. And I think they are also got exposure towards GCC setup or cloud or data-driven clients. So from that perspective, they are doing relatively better. But sum total, we are seeing a bit of a U-turn in the US towards H1B policy front, plus the overvaluation of AI is leading to this revival in the sentiment for Indian IT. So I think Indian IT is a clear beneficiary of this shift.
Right. Speaking of sectors which are looking out to US, textile is also in a dilemma right now. And at least some bit of it is due to the exposure to US. So, what's our outlook on textiles right now?
So Vishu, textile is one of the few sectors which was supposed to be impacted or one of the most impacted sectors. And I think tariff of 50% was there for about 40 days during the quarter. We've seen some companies coming out with numbers, the likes of say Gokuldas Exports, Indocount. I think all these companies have reported low to mid single digit kind of a growth. And what they have done is that so initially what they have really done is that for initial 25% of the tariff, they have the US retailers have or they have passed on the price hike, but the subsequent even 25% which has happened, I think that is where they have taken or they have given a discount of 15 to 18 odd percent. So in that process, they have taken an impact, and which is why when you look at the margin profile of most of these companies, that's a sort of on a downtake. And again, so for example, Gokuldas has witnessed a relatively lower decline of 160 odd bips to 5%, Indo count a bigger hit of nearly 5 odd percent to somewhere about closer to 10 odd percent. But bottom line has witnessed a double digit kind of a decline. Now, going forward, overall sense is that if the tariff is maintained at 50%, then the companies are clearly saying that they are going to gradually shift to other countries which have got lower tariff. And in case if the tariff is reduced to say 25%, then I think they are on par with competing geographies like say Bangladesh and Vietnam, because those geographies carry about 30 and 20% kind of a tariff. So from that perspective, I think for when that happens, the order inflow is expected to improve, and they need not share the tariff burden in that case. So I think that scenario will pan out in Q4. So our sense is that when we look at some of these companies now, so for example, let's look at company specific. KPR Mills has got lesser exposure to US because they've got exposure of 60% to the EU market. So that becomes a preferred pick because with EU we are going to sign a potential FTA plus UK we have already signed. So this is a company which we recommend to sort of buy. Indo count again is looking to sort of move up the value added segment, so that will lead to better profitability and slightly better margins. So that is how they are looking to sort of mitigate. Gokulas has got a significant exposure of nearly 70 odd percent. They're looking to sort of reduce that exposure to US to about 60 odd percent over the next 2 3 years. So I think all the companies are approaching different ways, but in case if the tariff gets reduced from say 50 to 25% or even lower, then I think everything gets sorted for the entire textile as a pack.
Right, right, sir. Coming to results this week, let's start with Asian Paints.
Oh yes, so Vishu, I think Asian Paints was clearly a big surprise for the entire street because overall expectation was a volume growth of 3 to 4 odd percent. The volume growth came in at 10 odd percent. So it's a big positive surprise. I think a good part also is that the company is saying that in the second half or next 2 quarters, they are expecting this double-digit growth to sort of sustain. Now, yes, they are still lower the prices by 5 odd percent. So overall revenue growth is still about 6 odd percent. But I think they still had levers, so their margins have actually improved by 240 odd bips. And I think what they are saying is that they are seeing benefits from painting demand pickup in the exterior paint side. Then there is a festive and wedding season. Then new demand is coming from real estate and hotels. So all that is led to a better gross margin, and companies actually upgraded the margin trajectory from 18, 19% to 18, 19% from 17 to 18 odd percent. So we were carrying a cautious view, but I think the kind of commentary and the kind of outlook what they've given, we have now shifted stance and given it to the buy with a target price of 3,330.
Great, sir. After that, let's come to finance. Bajaj Finance is another stock that declared their results this week.
So again, consumption stock, Vishu, but I think Bajaj Finance, the markets did not take the numbers very well because see, while on the headline side, it might look like that the AUM growth or the loan growth was pretty strong at 24 odd percent. Then asset quality was sort of stable. But I think where the market did not like is that the management has lowered the credit growth guidance, say from 24, 25% to 22 to 23 odd percent. And I think what they're saying is that in their captive two-wheeler segment, they are seeing some stress. They are seeing some stress in the MSME segment. And this stress was there in the H1 also, but they are expecting it to sort of continue in the H2 as well. FY27 is when they are expecting things to sort of normalize. But I think since the stock had already sort of rallied, and which is why I felt that for some period of time the stock may not do much. So which is why we have not given it a buy, and we continue to sort of maintain a hold rating on the stock. But things will become better 6 months down the line. Otherwise, I think no structural negative is what we would say in this stock.
Right. Next up, we have Eicher Motors.
Another consumption-oriented stock, fabulous set of numbers. I think this company delivered a volume growth of nearly 43% YOY. Top line growth was 45 odd percent. I think Royal Enfield continues to sort of do well. Margin profile also was quite decent at 25 odd percent. And I think overall sense is that so this company is saying that growth is again largely driven by the festive-led volume surge. But I think one more thing is that the company is looking to incrementally increase the overall capacity, because they're sitting on a capacity of about 12 lakh and they're already selling somewhere about 3.25 on a quarterly basis, lakh units on a quarterly basis. So which is why they have expanded their capacity to 1.35. And I think if the demand sort of sustains in the second half, probably they'll have to look for further expansion. So good set of numbers. This is again one of the premiumization plays which are there in the two-wheelers and iron. So for example, this company makes half of the turnover of Hero MotoCorp, but the profit numbers are largely same of Hero MotoCorp. So that is how they are sort of riding the premiumization wave.
Right. Next up, we have LG Electronics, sir.
So this company also, the outlook continues to remain positive. We need to understand that this number looks soft. So it's a muted quarter because again, there was a large or demand got deferred because of the GST cut. And which is why when you look at their segments, whether it is home appliances segment or entertainment segment, both of them reported flattish kind of numbers, margin sort of decline. And I think AC as a segment has been impacted the most because of the extended monsoon. But our sense is that Q3, Q4 onwards, things will start looking a lot more better. Q3 is going to capture most of the festive season. So from that perspective, I think though numbers look muted, but I think overall outlook is pretty robust from that perspective.
Right. How about Tata Steel?
So we should Tata Steel again. Numbers have been good because see, one last quarter they had a shutdown because they were looking to sort of upgrade. So this particular quarter, we have seen a volume growth. So volumes have gone up by 17 odd percent. EBITDA per ton has been slightly softer. One because see, while the 12% safeguard duty had been sort of announced. But China continues to sort of produce more and dump more. So this benefit of 12% is largely negated. And on top of it, I think in next quarter also, this EBITDA per ton of 15,000 might get down to somewhere about 14,001 because the prices are lower. Some of the costs, like say coking coal prices have gone up. But still good enough because I think why we are liking this company is that Europe is looking to put more safeguard measures, which means that the Netherlands profitability is expected to be a lot more better. UK is going to take a lot of time. And this company is expanding their capacity from say 26 million to about 40 odd million tons. So volume growth is expected to be good. And I think this 12% safeguard duty overall sense is that government might will come up with something on this. So I think this stock will continue to remain a buy despite the fact that numbers could have been a lot more better, but things will become better. I think China is still not really looking to vacate this manufacturing space. I think that is the clear thing which is coming out from the steel side.
Absolutely, sir. Next up, before we go to the our hidden gem, can we discuss defense sector for a bit? How does it look like right now?
Vishu, I think it can. This is one sector which can come back in limelight because one, Bihar elections are done and government has sort of categorized the Delhi incident as a terror incident. So from that perspective, some kind of a action against Harris Group can't be ruled out. And now, when we sort of come to numbers, now defense should not be looked at it from a quarter perspective because you see a lot of volatility in numbers and you can't really make head and tail in terms of where things are directionally headed. So I think half year is a sort of a better comparison, or yearly is a better comparison. So half year, if I have to sort of compare, the actual the overall turnover growth is about 11 odd percent. Margins are sort of down. Our sense is that the execution is expected to pick up from H2 onwards because this company is sitting on a fairly large order book of nearly 2.7 lakh crores, which is nearly 9 times of their current trailing 12-month revenue. So we continue to like this stock from that perspective. I look at Bharat Dynamics. I mean, this company has witnessed a nearly 90% jump in revenues. Margins have gone up from 6% to 10%. So again, that is the challenge in terms of looking at quarterly gyration. So again, this company we like because overall they're sitting on a fairly large or good order book. Take data patterns as an example. This was one of our Maurut picks, and now this company H1 revenues have actually doubled, and margins have actually declined from say 35, 36 odd percent to 24 odd percent because they executed one large order. So from that perspective, I think overall sense is that this stock again is going to deliver 25% kind of a growth and would maintain about 35 to 40% kind of a beta margins. We still maintain a buy on the stock. And I think if I have to highlight one more stock, say solar industry. So solar industry, the defense as a segment is expected to do a lot more better because they're sitting on order book of 15,000 odd plus crores, and this segment can keep on growing at 40 odd percent. While yes, number wise, some of the segments were soft. So for example, I think the domestic explosive segment was soft because again because of the extended monsoon for coal mining, you don't really require so much of explosive then. And but yes, again, if you look at it from a slightly longish perspective, this again is a very good defense play.
Absolutely. Finally, let's come to the hidden gem of the week. Which will it be this time?
So, Vishu, I think consumption has already done well. Our sense is that with Bihar election done, probably the focus will now shift more towards capital expenditure side or stocks which are going to benefit from lower tariff. So, LG equipment is what I'm recommending with a target price of 610, upside of nearly 22 odd percent. Now, this company makes a air compressor. And which is nearly 91% of their revenues. Besides that, they make some auto components. Now, 50% of the revenue comes from exports and the balance from the domestic side. Overall growth expectation is about 11%. Bottom line growth expectation is somewhere about 17 odd percent. Now, the reason why we like this company is that one, this company is clearly saying that they've been working on a number of initiatives, and which is why they have been able to take increase of 5 to 10 odd percent because they are looking to sort of manufacture motors of their own. So this, even if the US tariff remains at 25%, they are not going to get impacted from a margin perspective. Similarly, they have also worked on the incremental 25 to 50% or another incremental 25% tariff. So they have taken even measures for that. So overall sense, what they are saying is that that in case if this tariff were to remain, they would have taken a hit of nearly about $9 million from a FY27 perspective. But in all probability, our sense is that this tariff will get reduced to 25%, which means that with the kind of measures they have taken, they'll be sitting on a gain of nearly about $3 million from FY27 perspective. So this is one of the companies which is very well sorted in terms of how to sort of tackle the challenge of a higher tariff. And despite that, they're looking at sort of growing their top line and bottom line in double digits. And in case if the tariff scenario comes favorable, we feel that the stock should do well, and which is why we are recommending this with a target price of 610.
Absolutely. Well, that was it for this time. Thank you so much, Pankaj sir, for your time and insights. And thank you so much, everyone, for watching. If you have any questions, please put them in the comments and we'll try to get back to you. Thanks again.
Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.